All right, everybody. Hope everyone's doing wonderfully well. It is me, Gareth Soloway, joined by Ben Cowen. And again, guys, it is awesome to be here for another episode of the No Shill Zone, where you're going to get real data, real information, charting, not the crap that you can mostly find on crypto Twitter or in other spots out there. Ben, how you doing, buddy?
Pretty good. Just excited to get this week kicked off and see where the markets go.
Heck yeah. And then, so I'm going to throw it right to you. What's the number one thing you think investors watching today need to be looking at? Like, is there something specific that jumped out at you over the last few days?
You know, one thing that's interesting to me, and this is actually something I think we talked about maybe last week, the social risk is just hit a new milestone. This is, I've been tracking this forever. And the social risk, if you're unfamiliar with it, it's basically just tracking like retail social interest in the cryptoverse. And we have gone down to the lowest risk band for the first time in quite a long period of time. I mean, the last time that we entered into this level from higher levels was all the way back over here in October of 2018. So It has taken a long time, Gareth. And one of the things I think that has contributed to just how much longer people have stuck around this time as opposed to, the last cycle goes to all the excess liquidity, right? I mean, it just, no business cycle is the same. And I have to think that some of this excess liquidity created by the Fed, when they printed so much money, it takes a long time to absorb that back up. And I think that's also going to be reflected in the social sentiment in the space, right? We're seeing YouTube views go down across most crypto channels. We're seeing Twitter followers and all this stuff go down. Ultimately, though, we know that should theoretically create opportunity. I mean, as you can see, right? When it goes to the lowest levels, that's when you're paying attention.
Yeah. So the question I guess I would have is do we see this as being a, buy signal right now, or is it possible like historically I'm looking back at, was that 2020 where you kind of had a double dip, right, where we kind of almost came back down to those lows? So are we maybe at that first spot, maybe a breakout of 31,000 could occur in Bitcoin, but then you get that kind of double dip at some point?
I think the one thing I think about when I look at this is who's the marginal buyer of the altcoin market, right? Who's the buyer? Back over here, we saw it going up, right? So like, yes, it was possible that price goes down because price is always irrational in the short term, right? It's possible that price goes down, but we saw new people coming into the space, right? So you knew there was we were trending in the right direction in terms of bringing people to the table for crypto. Yeah. Now it's trending in the opposite direction. So that's not to say that you can't have squeezes higher. I mean, we've seen that. We normally see that in pre-halving years, but one interesting thing to clean this up a little bit is to take, say, like a 30-day moving average, right? And here it's when you start to spend a long time trending in the wrong direction, price normally does resolve in that direction, right? Yeah. It's like if you keep trending higher on the social risk for a long time, it doesn't mean that price can't go down in the short term, but eventually it resolves higher with the social risk. If it keeps going lower, then I would assume that eventually the price would resolve lower, more so in line with the general sentiment of the cryptoverse. I'm curious though, I mean, what are your views on this? My general thought, of course, is that if you spend a lot of time at these levels, it's a good sign, but we're still trending down to those.
Down. Yeah, and what's interesting here too is, like you're saying, prices actually of Bitcoin has moved higher. Obviously, alts have gone lower in general, but also the thing that I would kind of take note of is that it doesn't look like we're at the levels that we saw in 2019 and 2020 yet. We still have further downside to go as well. And the first thing that jumps out to me would be saying, okay, well, during those periods, you had quantitative easing, right? So there was Federal Reserve printing money, interest rates were lower. We now have a scenario where we're still above that level, those bottoms, but we have liquidity being sucked out of the market. So in the very least, if it was just me, I would say likely that social index should get down to those lows, if not go a little bit lower than what we saw then because of the lack of liquidity.
Right. But, I will say we're getting close, right? I mean, it's, you give it a few more months. I think we could see this thing ultimately bottom out. And one idea too, Gareth, for the social risk is maybe it's a better indicator for the altcoin market, right? Rather than specifically Bitcoin. Because, the social risk has been going lower, but altcoins have also been going lower, right? A lot of them have already put in new lows. So
Yeah.
I'm thinking maybe the social risk is a great indicator for when altcoins become worth the risk.
Yeah, and bringing up this, and this is a good segue. So I got to show this chart here. This is the Polygon chart, and again, just from a pure technical standpoint, you see this trend line, and then this one, which look, this one goes all the way back to February of this year, connecting through these highs. And look at what's happening to Matic right here, Polygon. It's beginning to break out. So again, and by the way, this doesn't mean like, oh, it's going back to $1 or $5. This is just a short-term breakout where upside to me maybe back to about 83 cents, which again, 13 cents higher on a 70-cent move. That's actually, what is that, about 20% move. So again, this just crossed my plate this morning, and I'm like, okay, this does kind of tell me that the alts may, at least some of these alts that have really been beaten down, may be on the verge of getting a little reflex rally to the upside. And if we take a look at Cardano, let's just see what we got on that one, because that's kind of in the same path. This one, interestingly enough, is not doing that. So for me, this area right here would be the breakout, these highs. And short term, we haven't even gone up there. Matic, in comparison, would be trading up against this downsloping line or breaking above. So interestingly enough, Cardano is lagging Polygon versus Polygon's actually looking a lot stronger relative to some of the other altcoins. So yeah, interesting.
Yeah, if you look at Matic, I think what you mentioned, like 85 cents or so, that's actually right where the 20-week SMA is trending towards, right? The 20-week SMA and the 21-week EMA, they're both trending to that level, and that is historically a pretty big level for altcoins to find some resistance at this stage of the cycle.
Yeah, and just for those of you out there that are new to technical analysis, one of the reasons why this, or the main, just like you're mentioning, there's a 20 moving average there, but also when you look at price and it kind of comes down and it trades sideways, the reason why that creates resistance when you're below and you're coming back above is because to go sideways in a chart, there's a lot of buyers and sellers that are meeting, right? They're kind of, buyers are selling, and then or buyers are buying, sellers are selling, and that's why price doesn't go up or down. It kind of just goes sideways. But you get a whole new group of buyers there, right? So think about, let's say I was there, and I'm not, but let's say I was one of the buyers and I was at 85 cents. Well, all of a sudden it broke down. I thought it was going to go this way, and again, I'm speaking from the perspective of being a retail trader. And instead it dumped out to 50 cents. I found myself down on this trade, hypothetically down 30-40%, right? And so the thought process is when I get made whole, when I get back to break even, I was sweating when it was down there. Oh my goodness, the SEC is going to, crush all these things. I get back to break even. There's a psychological want for me to say, okay, I'm back to break even. My account is back to where it was. Cut it. Just get out. Just say, be thankful. And that's why these turn out to be pivot points on the chart where there's resistance on the way back up. You get all these buyers that were buying in here and then thinking it was breaking out. They're all now selling and saying, all right, thank goodness I got out without being crushed too much.
Right. And actually, it was about a year ago, I think, when altcoins saw at least some renewed strength back up to the upside before they eventually rolled back over going into the fourth quarter. But if you think back to like that July timeframe, Matic had a pretty good rally. Cardano did. Here's an interesting chart that I like to look at sometimes when it gives us the idea of how these cryptocurrencies have been performing. This takes the ROI after the peak and look at where Bitcoin and ETH are compared to Cardano and Solana, right? Like it's just night and day. And it shows you just how badly the altcoin market can get beaten down. Recently, we've seen Solana up a lot, right? It's actually been outperforming Cardano, I think, in the short term. But when you measure them from their highs, it still is actually lower than where Cardano was. So a lot of this, I think, is just mean reversion back to sort of the overall index of the altcoin market. And again, I think the issue with the altcoin market is, well, what happens if Bitcoin and ETH, the blue chips, if they roll back over, let's say in the next few months, what happens if they roll back over? That's where the altcoin market just keeps getting crushed. There's a really interesting chart here when you look at the altcoin market. I think it's really interesting how well this stuff works out. So this is total 3. So the altcoin market minus USDT market cap divided by Bitcoin. And you'll see that alts tend to top out at parity with respect to Bitcoin, right? When the altcoin market cap equals the Bitcoin market cap at 1, that's where they tend to top out. And where they tend to bottom out is around 25% of Bitcoin's market cap. So I'm looking at this and I'm saying, all right, well, altcoins are currently 42% of Bitcoin's market cap. What happens if we go back down here? That's another 40% drop,
Wow.
on their Bitcoin pairs, right? On their Bitcoin pairs. And the other fascinating thing about this is roll back the clock exactly 4 years. We were at the same valuation. All Bitcoin pairs were collectively at the same valuation in July. And then by September, they had dropped that 40%. Again, this is a little bit different than what you're talking about because you're looking at their USD valuations, right? And their USD valuations can do all sorts of things, but it's always what is their Bitcoin valuation doing, right? And are they getting wrecked against Bitcoin? Are they not? And I think the reason I look at this is because I want to know, when does the altcoin market become a better macro investment, right? Because you're looking at the short-term stuff, right? You're looking at the short-term play. How can I squeeze as much out of this? Because it's like, you have to trade with what you're given, right? If you're given an altcoin bear market, you trade the altcoin bear market. Yeah. But I'm trying to figure out, like, when does the altcoin market finally become worth the risk? And I mean, could be within a few months.
Yeah, and I think that's where I'm leaning, is that I really do think, and I think I even said it last time, is that the alts at some point we'll be able to figure out their valuations once we get clarity from the SEC, right? And so the SEC will say, okay, these are the rules. And then all of a sudden, big money will be able to start valuing these things. And so whether, the market caps on a Matic should be 5 billion or 25 billion or maybe 50 billion, we don't know yet, because again, we don't know what the real valuations are, but that will become clear. And my guess is at that point, that's where the value really starts to, and by the way, that's actually a good thing. Like investors need to understand that any sort of additional information that these coins can give us makes them the clarity and the transparency much better, which allows us, even as retail investors, to say, okay, I think I should pay here for this versus where it was before. And I think that's important for us.
Yeah, and I mean, even with the altcoin market, like, because you love playing the short-term trades, right? Like this level right here, it has been a level where we've seen alts bounce before, right? I mean, so it's not to say that can't happen. Like, you could have a scenario where they bounce back up. It doesn't necessarily mean that the bleed is over. It's just that we know markets do not move in a linear fashion, right? Like, it's a stochastic process, and that's what really gets portfolios chopped up so much, is people shifting from one view to the other every week because the market's doing something new.
Right. It's the emotional swings, highs and the lows, right?
Exactly.
What do you, just one thing I just want to, we always touch on this, and I think it's important to touch on this, is I was looking at the Bitcoin dominance chart, and with Matic starting to inch up, you actually have a very short, and again, this is very short term, because I think you and I both agree we're headed towards 57 to 59% dominance. But this is a little bit of a bearish pattern, and interesting to see the alts beginning to show a little sign of life. What I would be almost expecting is some sort of secondary short-term move. And again, mind you, short-term move, but a short-term pullback, maybe right around 50% before that next leg up. And this is what we would refer to, again, a sharp candle down with a little inside bar consolidation that might be telling us that. So that's another signal from a TA, just strictly short-term technical analysis, that maybe the alts are waking up. And then it brings, and again, I'll let you comment in just a minute on the dominance, but I do want to just bring up the Solana move has been really impressive. And that's another alt, right? Where Solana just in the last, really just since June, mid-June, so we're talking less than a month, or right about a month, is up 50% off of its lows, which is very, very impressive.
Yeah, I mean, I think you nailed it. I mean, the dominance, as we saw last cycle, it actually went to 52, and guess where it pulled back to? 50 before it continued, right? So yeah, there's certainly a chance that happens. I'm by no means saying that it can't go down. And one thing about the dominance as well is that it keeps bouncing off its 100-day or some other moving average, right? I mean, you can see that it has this process where it goes up and then it consolidates for, a few weeks or a few months and then goes up again. And it just kind of keeps doing this thing. And so, yeah, it's possible that we're in this phase already again, and we could be in that sort of that consolidation window where it goes back down, maybe a percentage point or something. But again, like, I think the general idea is that it's going to explode higher. The one thing that I'm not sure about is which way is it going to go, like, this week or next week? I'm pretty confident that it will continue higher, but I just don't know how long this consolidation period is. Last cycle, by the way, it wasn't a very long consolidation period. I mean, it went from 52 to 50, but it made that move in only like 4 days. And this time it's obviously taken a bit longer here. I mean, now it was at 52 late June, and now we're in basically mid-July. It still hasn't hit that 50% level. I don't know how long it's going to take. I don't even know if it has to go to 50%, but you're right. Like, there is some reason to believe that it could consolidate for a little bit longer before breaking back up.
Yeah, I think that's what's so cool about the dominance chart or any of these charts is that generally they still abide by the technicals of what an Apple chart will do or anything. And I think that's always been the big question for people, at least when they come to me. They're like, well, you've always traded stocks. What makes this work on cryptocurrencies, or what makes it work on commodities, or what makes it work on dominance? And the beautiful thing about it is that technical analysis isn't about the specific asset. It's about the people that are trading the asset. And if you go back to I don't know if you know much about the tulip mania in the 1500s, Ben, but I mean, the same greed that drove, I mean, people literally were buying homes for one bulb of tulips, like one tulip bulb. I mean, that's how crazy it got, which again, that greed is the same greed that helped the dot-com bubble create, the housing bubble in 07 leading to 08, the crypto bubble where we saw shit coins and everything go up like crazy. I mean, it's the same thing. And so when you're charting things, as long as you have human participants, now you can get into AI and what happens then, who knows, but human participants, it should behave the same way.
Right. Well, I mean, it's just like, yeah, like the .com, like, you saw the same stuff happen just over 2.5 years,
Right.
By the way, this is an interesting chart. I normally pull it up on my website, but you can actually view it on TradingView. This is basically an approximation of the Bitcoin dominance, excluding stable coins. So this chart looks a lot different, right, than when you include stable coins. I mean, it really does show that it's just been in an uptrend for basically 2 years,
Yeah.
And this is the one thing that maybe you get a pullback to this breakout, or to this prior resistance level, right, which would correspond to 56%. Right now it's at 57.5%. If you exclude stables, maybe that's the pullback that you're looking for on the altcoin market, or sorry, on the Bitcoin dominance, that would then lead to the next renewed search tighter. And you can see that the prior moves higher here, they pulled back a little bit before finding that renewed interest in the Bitcoin dominance to a much higher level. I think it's a great thing that we talk about the dominance on a weekly basis, because it really does tell the story, I think, of the cryptoverse.
I agree. Now, I think last week I heard that I think it was JP Morgan basically coming out and saying, "Hey, we don't think that the spot ETF is going to be a big event for crypto, or at least for Bitcoin." Are you in agree? Do you have any ideas on that, or any thoughts on that? For me, I kind of looked at it and I said, "All right, I agree, but the positive about a spot ETF is that it will be more accepted by investors that may not have crypto accounts. So it should overall in the long term help. But I understand how in the short term it's creating a lot of buzz. But the question is, does that buzz generate a big up move?" And again, I don't know if you have thoughts on that.
Yeah, it's hard to say, because normally the narrative follows the price, right? Not the other way around. Price doesn't normally follow the narrative. So if it did, then that would be somewhat surprising. I think that the more interesting thing to me is just, where is liquidity, right? It's kind of like in a bull market, no one cares about bad news, and in a bear market, no one cares about good news. You just ignore all that, because it is what it is, right? You have lower liquidity, people can't buy it, right? Even if you have easier access to buy it, it doesn't mean that people have that capital to put into it. If it's if it's a bear market, or maybe if it's a bull market, they ignore the FUD, because you can't tame animal spirits, right? In a mania phase. My sort of thought process here is that it's kind of twofold. First of all, if people go into this idea of buying these spot ETFs, it does detract a little bit from the not your keys, not your crypto narrative, right? That a lot of true Bitcoiners would hold on to. Be that as it may, it would give people access to Bitcoin in ways that they haven't had access before. And so I would say long term, it probably is a net positive thing. If you want, like we've talked before about how, you can be pessimistic on short-term price action, but still see the bull case, right? And I mean, I think we're both in the camp that Bitcoin does eventually go much higher, eventually, right? Eventually. And in order to get to that 6-figure level, I mean, you have to have institutional money coming in, right? I don't think you can reach 6 figures for Bitcoin without easier access to crypto and institutions basically getting the green light on accumulating it and holding it on their balance sheets and all that sort of stuff. So I'd say it's probably a net positive in the long term. In the short term, I think it's probably irrelevant.
One thing that kind of jumped out at me, just I think it was a week or two ago, when we heard that MicroStrategies had bought another 100,000 plus Bitcoin, and the reason why that jumped out at me is I was a little bit concerned that price didn't go up more with that big of a buyer in the market. And the question is, if it didn't go up more when they were buying that much, who was selling into them? And again, again, not that I'm not going to pretend that I know, but it is, kind of the same along the same lines of, when you have good news and something doesn't go up. I mean, we had the ETF news for the spot market, and we didn't see a breakout above 31,000 yet. Now, maybe it still happens, but these are little things that I kind of just am saying, that's kind of interesting on a price action. Now, again, the bulls are gonna say, hey, it's going to happen, and long term, I believe it will. But again, that's just something that I'm kind of a little bit concerned about when it comes to Bitcoin in the near term. The price action hasn't been, breaking out above this level.
Well, I think liquidity is everything. And if you take a look at Binance US, I mean, you can see where Bitcoin's currently trading,
Yeah.
27,600. It's not really, I don't really think of this as like an ARB opportunity. It's just a very risky setup right now. Liquidity, right? I think there's a lot of liquidity issues going on. And I mean, these things to large players can't be like the most optimistic view of the market, right? When you're looking at the spread on this from one exchange to another, literally be 3,000 different, And I mean, like that's the issue. And I mean, you can see very similar things. I mean, it's not just Bitcoin, right? Like if you were to go look at ETH USD over on Binance US, it's trading at 1,700. And we know that it's actually trading at much higher valuations on basically everywhere else, Yeah. So I mean, that could be there's little like nuggets here and there that would suggest like reasons why price action's getting held back. I'd be curious too to know your view on MicroStrategy from the standpoint that, in the past, buying MicroStrategy basically gets you access to or exposure to Bitcoin without actually having to hold the underlying asset. Like, so if someone doesn't want to hold the underlying asset, maybe they just went and bought MicroStrategy stock to get that exposure. Do you think that if spot ETFs are made available, could that detract from MicroStrategy's valuation? Because now you can go get exposure like a lot of other places, or do you think it would be bullish for MicroStrategy?
No, so I think that's a really good point, is where, if you look at the MicroStrategy's chart, and essentially we know how much Bitcoin they're holding, essentially more Bitcoin than the rest of their business is worth by 10x, or maybe even more than that. So I think you're right on that, is that you bring in an ETF that's spot. Well, now again, you could argue that MicroStrategy has been the equivalent of the ETF for Bitcoin that is spot based, because it goes up and down so much with that spot price of Bitcoin. So I do think you're right about that. I think we might see MicroStrategy lose some value and come back to a more realistic price based on Bitcoin times how many coins they have on their balance sheet. I think you value the company slightly, but to be honest, their underlying business is not worth that much. It's worth, a small amount. So I think that is a very good point on MicroStrategies. It kind of takes away the idea of playing it to just be a Bitcoin play.
Yeah, and it kind of goes back to the whole like the GBTC stuff, right? And how, it's continuing to trade well below spot, right? Like the discount to NAV is what, like 20-something% right now on GBTC. And I think one of the reasons it's gone up in the short term is because people are sort of speculating on perhaps it getting converted to a spot ETF. But there's also a lot of stuff going on in that world that is not. I mean, you're seeing like all this sort of litigation happening and whatnot between a lot of the major players, and so it's a risky play as well. And I mean, ETHE is trading 47% below spot. So at some point, it's almost like you're trading a completely different asset.
Yeah, I think that's the crazy thing about it. And just looking at the ETH chart real quick, I saw a couple questions asking about the ETH analysis. And, just from a technical standpoint, you're above this channel. So you had a little bit of a breakout of the channel, but the price action over the last week or so has not been good, where you made a higher high and then you reversed that pretty quickly, and you're making a little bit of a bearish pattern here. So based on this, the probabilities are that we probably need to retest this line right here before maybe making an attempt to rally up. Now, the reason, one of the things to look at here in terms of technicals is if you look at this trend line, look at how this trend line is ready to merge into it. One of my favorite technical plays on a chart is if price comes into two moving average. Well, you could have moving averages, you could have one moving average and a trend line, but essentially the idea is if you liked it at a moving average, or if you liked it at one trend line, if you get two trend lines together, it creates an even stronger support. So if, let's just say, we pull back into this area, let's say it takes that long, this would be an even better buying opportunity on ETH for a bounce versus if it was just coming down right to here where it's just one. All right. So again, just kind of something to kind of keep in mind there.
Yeah, well, it was actually in July of 2019. I mean, it's funny how cyclical crypto is, right? Like there's so many things you can look at and say, like, basically the same thing happened. And I know the cryptoverse is more complicated than that. It doesn't, not everything revolves around the halvings. There's also this QE element and interest rates that you have to consider. But it was exactly July of 2019 when the Ethereum rally basically found itself sort of back below its 20-week moving average. And then it was kind of struggling for then the rest of the year, actually. Now, it doesn't have to play out in the same way, but here's actually an interesting chart I was looking at earlier, a couple of interesting ones. If you were to plot out the year-to-date ROI, not of Bitcoin, but of the Ether Bitcoin valuation, so Ethereum's valuation against Bitcoin, and you look at where it is in 2023 and look at what it did in 2019. So basically 4 years ago. And so this, again, it's sort of like looking at it in a different way. This is not the USD valuation, right? Like the argument here is that the only way that ETH goes up on its USD pair, like if it bounces back down to that trend line you posted, if it bounces back up, it's only because Bitcoin's also bouncing back up, right?
Right.
Is likely. And if Bitcoin doesn't bounce back up, then it could go below that trend line. So, but the argument here is that, well, Ethereum's Bitcoin valuation could go down regardless. And I think there is still a case to be made that is the most likely scenario. I go back to this chart over here, this Ether Bitcoin monthly returns table, and look at the average returns from June to December, right? It's not good. And last month, Ethereum's Bitcoin valuation gave us about -7%. That's the average in June. In July, the average is about -4%. That's more or less where we currently are. I think that Ethereum, I think that it's likely going to struggle on its Bitcoin valuation for most of the rest of the year, and then probably pick up pace again sometime next year. As far as the USD valuation is concerned, if I'm being completely honest, right, I'm not convinced that it has found its bottom.
Yeah, on the dollar. Yeah,
on the dollar. Yeah, I'm not. I mean, I know that's not a popular view to have, and one of the reasons I look at that is I have this regression band for Ethereum, basically fit to what I call like non-bubble data, and normally before the real bull market that takes us to new highs, we come back to the lower regression band that's fit to sort of like non-bubble data. And that would still suggest a double bottom at the very least.
Yeah.
And so that is something I keep struggling with Ethereum is it looks bearish on its Bitcoin pair. And if it's bearish on its Bitcoin pair, then I don't really want to touch it, because I'm like, well, if I'm going to touch it, if I'm going to touch something, I'd rather just get into Bitcoin, because it looks like most things are bleeding to Bitcoin, right? At least on a monthly time frame. I know you're doing the daily and the weekly stuff. So this is something I keep looking at. Like this here would be a crazy opportunity on ETH if it comes back down to kind of like where it has in the past.
Yeah, look at that. Look at the moves off of that low band. Yeah.
Yeah, and that low band is around 600 right now. And I mean, if a $600 ETH is a new low, I mean, it doesn't have to happen, right? Like it doesn't have to go to a new low, but I'm just saying, like, I don't think we should rule anything out. I mean, even in last cycle, it basically double bottomed. At $80, like $80, and then later on it basically went down to 90. So this was like, this was 800, and I'm just curious, is it going to go back down to that, to that $500-600 level?
Yeah.
And I don't know. There's actually an interesting chart that you could look at, and it's certainly not playing out in the exact same way, but the Nasdaq back in the .com crash, it's funny how it basically peaked out at Ethereum USD's peak, right? It peaked, the Nasdaq back here peaked out at 4,800, right? Isn't that where Ethereum peaked? And look where the low was. Look where the low was. It was below 800.
Wow.
So and it took a long time to get there too, though. I mean, you're talking 132 weeks. If ETH took that same amount of time to reach that same valuation, 132 weeks from the high, you're essentially talking about sometime out in early 2024 before it actually achieves that.
Wow, that's actually fascinating. That's fascinating. The 40, I didn't put that together. The 4,800 and then the retrace back down.
Just to give something for the bulls, if you do look at that, if it does go to those levels or even close to it, if it double bottoms or something, look what happened next, right? Over the next cycle, it went all the way up to 16,000.
Just out of curiosity, so now you got me thinking about this. So let's see. So where's the equivalent of let's say we went to, so would we be in that last cycle portion then where the NASDAQ went down before that final move down? It looks like the final pivot point, maybe that was the low, and maybe that's where we are on the chart, right? So that was the low at 900 because it got down to about 900, right?
Yeah.
And then this bounce would be that bounce.
This bounce here occurred at a 77% drop from the highs. And would you care to take a guess at where Ethereum would you care to take a guess at where Ether USD? I believe it was around the same. I know Bitcoin bounced at 77%. I know that. I think Ethereum bounced around, it was actually a little bit less, I think. It was maybe 82. So a little bit less, but it was also on this wick. Like the real bounce where it had daily closes at and whatnot was around that 77-78% level. So again, the wick was down to 82%. I'm still thinking that even if it doesn't put in a new low, right? Like there's always a chance it doesn't. Even if it doesn't, I still think you're likely gonna come close to it at some point within the next. I mean, again, last cycle it didn't occur until the Q1 of the halving year, which is still, you're talking about another 7 or 8 months from now.
Yeah, that makes a lot of sense. And again, cycles like that tend to repeat in all assets. And again, it's just something to keep in mind. I know everyone's so into this 4-year cycle, but that certainly would throw a curveball in the 4-year cycle if we don't, bottom out until early 2024. Yeah.
No, there was actually a lot of coins. So ADA put in new lows 2 months before before Bitcoin's halving last cycle. I mean, it shows you that even when Bitcoin doesn't put in new lows, how the altcoin market can get wrecked and put in new lows over and over and over again.
Interesting, man. Interesting. So I want to pivot over. You had mentioned the US dollar here, and I think this is an important chart for us to take a look at because I think last week I was showing you guys this chart of this kind of this wedge pattern that was being created, and just in the last 3 trading days, the dollar, look at that, it's starting to just inch below the trend line. Now, again, this, we've inched below on an intraday basis multiple times over here and touched it right here. But this is something that I would start paying attention to in terms of a potential breakdown on the dollar. And to extrapolate that out, I think that what that's telling us is that we're now starting to get jobs data that's weakening, right? So up until the non-farm payrolls on Friday, we were always beating numbers. Well, now we finally missed the number. We came in a little bit less. In fact, I think at 209,000, the market was expecting 225. But if you looked at the numbers, a couple really bad negatives for the market. Number one, 60,000 of the jobs of the 209 were government. So the government actually created 60,000. So if you remove that out, now you're down to 150,000 jobs, which is a pretty significant miss on the number. And to make matters even worse, the hourly earnings actually, I believe, went up. Correct me if I'm wrong, but I know it wasn't a good number, but it actually upticked a little bit, which is even worse because if you have a weakening economy, but inflation pressures are still kind of there, the Fed is not going to step aside and lower rates, and they probably will be hiking later this month in July.
Yeah, I mean, the market's currently pricing in a hike in July, and you're right. I mean, I think the reason the labor market is as resilient as it is, I mean, look at government job openings, putting in new highs, but look at other sectors, right? Like look at manufacturing. It's just going down. And I mean, we see this a lot and it's not even just manufacturing, right? You can look at like durable goods, it's going down. I mean, I think we've talked about this before, right? Like the reason, one of the reasons why unemployment hasn't moved is just because we're just going back down to prior trend. But I mean, if you keep this pace up for just like say another 3 to 6 months, like you're easily below trend. And that's where I think it becomes an issue. I'm curious though about your view on the dollar, because I honestly have very mixed feelings about it. I I certainly have like certain views on it, and we talked about those last week. But do you think there's one of the things we've seen with the dollar, right, is that if it's going down, normally risk assets go up, and if it's going up, then risk assets go down. Do you think that if the dollar breaks down, that's bullish for risk assets, or do you think everything could break down together?
So the dollar going down, as long as inflation is low, is a positive for risk assets, which is what we've experienced for the last 20 years, right?
Right.
So ever since really the early 2000s, inflation was very, very minimal, 2% ish, maybe even a lower, which is why the Fed was able to print so much money. The tricky thing is, and the reason why, by the way, is that when the dollar drops and inflation is low, then the Fed can ultimately print money, right? I mean, if the
Right.
economy weakens, they can come out and save the day and print more money. It weakens the dollar by them printing. But again, inflation's not high enough to cause an issue. The issue now is that it's a weakening economy that, again, it looks to be dropping that dollar, but inflation is going to keep the Fed on the sidelines. And again, that's the big concern here, is why you can actually get a scenario where the dollar weakens significantly and risk assets still go down. And again, this even brings up potential issues of stagflation, where again, if the economy weakens and you still, let's say, have 3% inflation above what the Fed wants, you're going to be talking about stagflation. And I think it's important for everyone to understand how negative that is. So generally, in most of our lives, we've experienced, except in the 80s, right? In the early 80s, late 70s, when inflation goes up, the economy usually is doing very, very well. So people have more jobs, they're making more money. So you can afford to pay more for an Apple or for a TV or for a car. When people start losing jobs and making less money and inflation goes up, the gap gets much, much wider, and it's much harder for people to pay for those higher cost of goods. And so that's why in stagflation is like the boogeyman when it comes to economic conditions.
Yeah, if I go back in history, it's like normally when the dollar was going down, risk assets are going up. But you can find like a couple of examples where what you said is actually what happened, right? Like the dollar was going down and risk assets were going down with it. But you have to go back quite a ways to
Yeah.
find examples of that. It doesn't mean it doesn't exist, but it has previously happened.
Yo, can you jump back to the 19? Do you have the data back to the late 1970s, 80s? I'm just
Yeah.
curious what the dollar was doing then.
So this is what I was looking at before, like way back when, because if you look over here, so this right here is the 1981. This was the move coming out of the decade, the inflationary decade. This level that the dollar reached was right around 114, which is exactly
Mm,
where we just hit. And then after that, it actually pulled back to levels higher than where we are today. Now, I'm not really of the camp that it's going to do anything like this. I think at least not anytime soon. But that's why I'm curious, because, coming out of the inflationary decade of the 80s, we had two recessions and the dollar shot up quite a bit. I don't really think we're recreating these conditions exactly how they were back then, but that's what's kept me on my toes with the dollar, is like, well, what happens if it just blasts back up to the upside?
yeah, absolutely. Absolutely. Interesting. So now just going back to some of the data, and I think this is important for investors to understand, is that so we're starting to see maybe, and I say maybe because again, it's one jobs report. We don't know. We need to see more than just one data point to really know that it's not just a fluke. But I think that's something now that becomes very important. We have the CPI data on Wednesday, which will be the driving force. And then going into the next few weeks before the Federal Reserve, we're going to get a lot of big earnings announcements. Apple, Microsoft, all of these big players by the end of essentially July will have their reports out. And I'm very curious to see, do they continue to blow away numbers, or do they start talking about weaker demand for goods that could affect? I mean, do they have to lower estimates essentially?
I feel like the first wave of layoffs was more so just to get ahead of what they saw coming, right? Like they knew what was coming. I guess the issue is what happens if they are get to the point where they are forced to lay people off because they no longer have that nest egg that they had, back in 2022. As the years go on, interest rates stay high, QT continues. That's where I think it becomes an issue. But with inflation, what's interesting, if you look at core, it's basically been at 5% all year. And
Mhm.
I think the Fed would really like to see some progress here. And I think you're right. I mean, look, if core is coming in at 5%, the Fed's probably going to raise. I mean, right now the market's suggesting 92.4%
Mine too.
chance of another hike.
Yeah.
And we're potentially looking at going to 575 later on in the year, which I mean, I don't know how likely that is, but I would like to think that 5.5 is sufficiently restrictive, but who knows? I mean, the economy has been surprising. But if you look at headline inflation, I mean, look at this. Like you had, 2 months ago it was at 5%. Last month it was at 4, and now the consensus is 3.
Right, yeah.
So, at what point, I guess, do we start to weigh in the risk of rapid disinflation, right? And
Right.
going to the point of deflation. I mean, I'm not saying it's the most likely scenario to go deflationary, but at what point, does that become a risk? And I guess that could become a risk if we go into a recession and then demand just drops off.
Yeah, and I think that's really important to kind of recognize. And then I would just say this too, and this is the mainstream media talking, that I've heard so much about this, where now the mainstream media is kind of like, oh well, what does it matter if they raise another quarter basis point or even two more hikes? Because look at how much they've already raised. What's another quarter? What's another half percentage point? And I would
Right.
just throw this out to people is like, all right, so you could use many analogies. The straw that broke the camel's back. I look at it like I used to work out a lot more heavy weights. I used to squat. Maybe I could get to 300 pounds, but at some point you put on an extra 10 pounds and I'm going to collapse under that weight. Right. So it's a matter of understanding that. And just, it's not just a quarter basis point. This is, I think I saw a chart of this. This is the most rapid increase in rates in the time allotment ever in the history of increases in rates, right? So yeah, we've gone from in the 70s to 80s a bigger percentage, right? I mean, we saw interest rates in the teens back then, but it was from a much higher starting point. This has been from such a low point to such a rapid increase.
I mean, you can see in the dot-com crash, it was these levels that they hit. This was the terminal rate. Or sorry, the financial crisis. This was the terminal rate. And then it was at these levels that basically sent things crashing back down, and the Fed was forced to cut to basically 0%. Also, this was a level back in the 90s where they started cutting here, coming out of the dot-com crash. We went a little bit higher than where we are. But again, I mean, this is one of those things where every incremental 25 basis points runs the risk of breaking something that we're not paying attention to, right? It's hard to know what it could be. There's 1,000 things that it could be. Normally what happens is it's something that no one's talking about, like no one's even thinking about, because if we're thinking about it, then people are probably planning for it and trying to get ahead of it. It could be something that we're not thinking about. And normally that's what leads the markets back down. And until that happens, they love climbing the wall of worry, right? We've seen the S&P climb the wall of worry all year long. And we saw it climb the wall of worry in 2019 as well.
Yeah, I thought one of the things I think that was interesting, and again, I know you don't follow the equity markets too much, but Friday we saw very interesting stock market price action. We opened a little bit lower after the non-farm payrolls, and then we floated up most of the day till about the mid-afternoon, and then there was this massive sell-off in the late portions of the day. And I thought that was really interesting because it was almost like bigger players, the volume spiked dramatically, and it almost seemed like bigger money was coming in and just saying, okay, we saw this, we saw the hourly earnings, like you said, the core rates staying high. This means the Fed's going to hike. But we've had such a kind of a narrative for the retail investor that has been like, hey, you just got to thing as well. So you wonder at what point are the institutions really starting to say, okay, enough's enough. This market can't stay up. Or like some people think, maybe we are headed to all-time highs.
That's the thing. Like, what do you think the probability of that is? Because if you look at prior yield curve inversions, like it's kind of like a toss up. It seems like kind of half the time we put in new highs and then half the time we don't.
Right.
Are you leaning in any specific direction right now, or are you just sort of playing the chart as they come?
I mean, I'm playing it right now as that we won't. Mainly, I'm following this trend line, which goes back to the COVID lows, and it's just such a beautiful trend line. How we just seem to be staying. Now, if we stay, eventually, this trend line does get above the highs, right? It's a rising trend line, but
Right.
we're still talking months and months away. But I'm still leaning to it doesn't. But I will say this is that the psychological top in Bitcoin. Anytime I see a run up like this and then a midpoint dip, it brings up what in technical analysis we refer to as an M pattern, right? So if we go to Bitcoin, what we saw was that look at that, right? And again, so maybe this is a little steeper than what we saw in the stock market, what we're seeing in the S&P, but are you going to create that type of event before the big collapse? And there is that narrative out there where you do have some people that are saying, okay, well, the markets will collapse, but it's not going to happen for a few years. In fact, I think even you were talking about that, is maybe it's not quite there yet in that scenario. So I think there's two scenarios. I'm in the scenario that we won't make a new all-time high, but I do think you have to take both seriously.
Yeah, I think for me, like where we are is, I mean, I'll be like, coming into this year, I thought the highest the S&P would go would be like 4,300, because I saw the case for it climbing the wall of worry, but I didn't think it was going to climb the wall of worry as aggressively as it did.
Right.
I mean, because now we're at 4,400. If you look at this chart, we've talked about this a couple times as well, right? This is like global net liquidity, or an approximation of global net liquidity. I mean, the jaws have opened. And it's hard to know how long they stay open before they clamp shut. I mean, last time they opened back over here in December 2018, they didn't clamp shut until about 14 months later. But in 2018, when the jaws opened in April, they clamped shut. They started the process of clamping shut only 6 months later, right? So it's really hard to know how long the market can climb the wall of worry. I'm guessing it will climb the wall of worry until it has reason to not do so. And that normally that reason is the labor market, right? Like, until the labor market goes, it loves climbing the wall of worry. It doesn't mean that it won't have any pullbacks, right? But and if you look at charts, I'm actually gonna I'll try to.
And just one thing to just mention, and a couple of things. So this divergence, the jaws, to me right now look much steeper than in the past. I don't know if you can go back again and just see. But to see how the divergence was much at least the yellow line is much more gradual.
Right.
But the other thing too is I'm noticing is the market made new highs in each of those instances. So it just in each of those times it looked like it was a new all-time high.
It did. I mean, it in both of those cases it did. Again, it doesn't always. But in both of these cases, it did make new highs. But you're right. I mean, like, global net liquidity back then wasn't going down as much. I mean, to give you an example, right, from this high here, global net liquidity was at like 21 trillion, and then it went down to what, like 20 trillion. Like, not a huge move. Look at it today, though. I mean, just in the last couple of months, it's gone from like 28.5 trillion to 26.5 trillion, right? Like, it is now, maybe as a percentage, it's not as bad, but I mean, that's where we currently are, right? And people, if you're wondering, like, why is it going down so quickly, you have so at the beginning of the year, you had, or late last year, you had China reopening and Japan, right? You had Japan and China printing money. Now both of their balance sheets, I believe, especially China's, they've been going back down. Like, if you look at the Bank of China, but this big drop in net liquidity that we had last week is courtesy of the ECB. In fact, they're actually starting to become more aggressive. They talked a few months ago about increasing their QT come July, and now it's July, and they put their money where their mouth was, and they've continued to sort of tighten here. And the Fed is going to keep doing what they're doing. So I think you make the case that they're likely going to just continue this as long as it takes, right? Like, they're going to do it until it leads to, my guess is they're going to do it until asset prices finally take notice. Now, I don't think they're doing it to lower asset prices, but you have the wealth effect, right? How do you tame inflation,
right,
if asset prices are going up, a few percent each week?
That's been my thesis, is that, especially with the housing numbers we've seen lately, consumer confidence, both of those are directly, you can look historically and you can see that both of those are directly tied to the stock market, right? When people see their 401k and they're like, okay, I'm okay for retirement because I've made X amount, then they're like, okay, well, now I feel like I can go buy a house, even with interest rates where they are. And same thing with consumer confidence. You just feel better about spending money when you see your retirement funds or your accounts doing much, much better. So I think that's showing us just that.
Do you think that, like, as we get later into the year, the real estate market could take another turn? Because, like, I mean, again, like, when you get into the spring time frame, that's when whatever demand there's going to be, right? That's when you normally see that demand. Do you think that could lead to real estate prices coming back down at all, or no?
I mean, I do think I'm in the camp, and again, I keep on going back to Jerome Powell's comments about telling people to wait to buy homes, that there would be a correction, and we only saw about a 5% correction, right? Which isn't enough for, first time home buyers are seeing they have to pay from 3%, now they have to pay 7+%, and whoop-de-doo, the home price dropped 5%. That's not going to really do it for them. So I still think that there is something on the horizon where, in fact, I was talking to some Airbnb holders, and they were saying how their bookings have dried up. Now, that may not, there's certain areas of the country and the world where I'm sure that's not the case, But if you're starting to see that, I still think that there's a lot of people that bought Airbnbs, second and third homes, on the thought that they could just rent it via Airbnb and pay the mortgage that way. And I do think that at some point, if they're not making mortgage, how do these people pay 3 mortgages, right? They have their current home they live in and then 2 Airbnbs they're paying on. And if they're not doing it, those houses will go up for sale very quickly.
I've heard a lot of people talk about like, how interest rates used to be much higher, and how like our parents, like when they bought homes, they would have been at much higher interest rates.
Yeah.
But your house value is also like, 10% of what they are today. Like, it's so unaffordable right now. There's I don't know if have you seen that affordability?
Oh, the affordability. Oh, it's horrible,
So
man.
bad. Yeah, I was curious. Like, if you look at like the Zillow Home Value Index, I almost wonder if it could be putting in like a double top. We've seen that across various asset classes. I mean, by the way, last time it actually topped out in the July-August timeframe. You can see August was actually where it topped out as it went into the back half of the year.
Yeah, I think that's right, man. So I mean I am in that camp. Like, I mean, if someone came to me and said, "Hey, should I buy a home?" I'd tell them to wait. I mean, wait a year or two. Doesn't mean, by the way, that rents are that much better. But remember, people, and I can speak for I mean, I bought a house last year, not because I thought it was a great time to buy, but because I have a family and we were living in a 1,200 square foot apartment, and my wife basically said, "Hey, if you don't do this, I'm gonna kick your butt," right? So it was like, all right, well, spend some extra money, don't worry about it, just to make the family happy and give us space. But the amount of money that I'm, between insurance and mortgage payments and home updates and home things that break, and this needs to be, I mean, it is not cheap, man. I mean, we have a pool. That means every week someone comes and cleans the pool, and so you have to factor that in. A lot of people will say, "Oh, owning is more expensive, or renting is more expensive than owning," but they're not taking into account all the ancillary costs that come with a house. And I think that's really important for people. There's something very clean and crisp about paying rent. You pay it, everything's included. You don't have to worry about something breaking and replacing it versus what we have with a house.
Yeah, I mean it's true, and I also think it's important though that it's also very like location specific, right? Like you could be right in like 99% of the world, like maybe prices go down. There's always going to be somewhere where they might just keep going up, and I think the places where they keep going up are probably the places that didn't go up a ton during the last couple of years, right? There are some sectors where they only barely moved up, or they didn't move up nearly as much, but some of the other areas like Phoenix and Houston, or like Austin, I think they're getting hit pretty hard, aren't they? Because
I think
they
are.
went up a lot, and so now they're paying the price.
Yeah, absolutely. Absolutely. So I would say, I think that's a great spot where we maybe conclude this week, man. It honestly, this might have been our best stream yet. I think just amazing alpha for everyone, and kind of just knowledge, but really fact-based stuff, Ben. So I don't know if you have any closing thoughts on anything, but I think yeah, man, I mean, very cool stuff.
Yeah, I think that's a great spot to end. We went through basically all the asset classes like we normally do.
Yeah, next week I do want to spend some time on the metals. I think that we'll go into platinum, copper. Copper's an interesting one, gold and silver. So come back for next week. We'll obviously do crypto again, as we always do in the stocks, and next week we'll have some data on the CPI data from this week as well. So there'll be lots to cover. But thank you guys for coming out. If you guys would share this stream, the recording is so valuable with all the insights. Please do that. And then also make sure you're following Ben on YouTube, on Twitter. Follow me on YouTube and Twitter, anywhere else you guys find us. But do be careful for fakes. I know, Ben, you have a ton. I have a ton as well. And they are out there like sharks.
They're everywhere. It's hard to avoid them. Yes. Anyways, thank you guys for tuning in. Subscribe to Gareth if you're not, and we'll see you guys next time.
Take care, guys.